Hello students, welcome to the study of social science. In this video, we are going to revise the whole chapter, Money and Credit for class 10th. We will discuss each topic of this chapter along with the most important questions answers for the second term exam. Money as a medium of exchange. We know that money plays an essential role in our daily lives. We use money to buy and sell goods and services. If we have money, we can buy all kinds of goods and services. Anything from a pen to a bungalow, we can buy if we have money. But previously, when there was no money or no currency in circulation, people used to exchange things. That means one product was exchanged for another product. This old system of exchange was known as barter system. Under this barter system, both of the parties have to agree to sell and buy each other commodities. For example, Ram is a farmer who sells the wheat to another person, Shyam, and in exchange he gets shoes from him. That means if a person has wheat and he wants shoes in return, he needs to find a person who can buy his wheat from him and can provide shoes to him in return. If he finds that person, then only this kind of exchange will take place. He will sell his wheat and buy the shoes. Thus, basically, the barter system is based on the double coincidence of wants. What is double coincidence of wants? The double coincidence of wants means both the persons' wants should be matched to each other. Both the parties have to agree to sell and buy each other commodities or each other products. What a person wants to sell, another person should purchase it. And what another person is selling, this person should buy it. This situation is known as double coincidence of wants. And if it is not the situation, means if the person A does not want the same product in return, then there is no double coincidence of wants. In this situation, people need a medium of exchange. Thus, money is used as a medium of exchange. Why money is used as a medium of exchange? Money is used as a medium of exchange because when money is used, a person can sell his commodity in the market and can get money in exchange. With this money, he can buy anything he wants in the market. So, the use of money makes it easier to exchange things. Now, we can easily answer these questions. What is the barter system? A barter system is an old method of exchanging commodities. Under this system, people exchange services and goods for other services and goods in return. What is the double coincidence of wants? The double coincidence of wants means the both parties have to agree to sell and buy each other commodity. Why money is called a medium of exchange? Money is called a medium of exchange because money is widely accepted token that can be used for the exchange of any good or service. It is widely used because the use of money makes it easier to exchange things. It has removed the major difficulty of double coincidence of wants. Now the seller can sell the product at any time, at any place. Money offers economic freedom to people and it can be stored easily. Modern forms of money. We know that before the introduction of money, a variety of objects like grains and cattle was used as a medium of exchange. And thereafter came the use of metallic coins. These coins were made of precious metals like silver, gold, and copper. Today, money is used as a medium of exchange with its different forms. What are the modern forms of money? There are two modern forms of money, currency and deposits with the bank. Currency includes paper notes as well as coins. And today coins are not made of precious metals like silver or gold, but all the coins are made of cheap metals like nickel, copper, bronze, etc. So why these paper notes and coins are accepted as a medium of exchange in a country? These paper notes and coins are accepted as a medium of exchange in a country because they are authorized by the Indian government. And who has the authority to issue the currency in a country. Only the Reserve Bank of India has the right to issue the currency on behalf of the Indian government in a country. No other individual or organization is allowed to issue currency in a country. And no other individual or organization can refuse a payment made in Indian rupee in India. Means notes and coins can be used as a medium of exchange if they are authorized by the Indian government. Another form of money is deposits with the bank. We know that people use only some cash amount for their daily use and the rest of amount they deposit in the bank. Why do people deposit extra money in banks? People deposit their money in the bank for two reasons. The first is for safety. People want to keep safe their money, so they deposit in the bank. And the second reason is interest. People get monthly interest on their fixed deposits, which means they get money on their deposits. So they deposit their money in the bank. And whenever people want, they can withdraw their money from the bank, which means whenever people want, they can take their money out from the bank. So these deposits are called demand deposits. Whenever people want, they can withdraw their money from the bank. So these deposit money is called demand deposits. Another facility of demand deposits is check. Through the check, people can make a direct payment without using cash. That means if they have to pay money to another person, people can make a payment through check instead of cash. What is a check? A check is a document that orders a bank to pay a specific amount of money from a person's account to the person in whose name the check has been issued. Means if you have to pay somebody and you do not have cash but you have deposited in bank, through the check you can make a payment without using cash. In short, there are two modern forms of money: currency and deposits with the bank. Currency includes paper notes and coins. Indian notes and coins are authorized by the Indian government, and only the Reserve Bank of India has the right to issue currency in a country on behalf of the Indian government. Another form of money is deposits with the bank. People deposit their money in the bank for two reasons. The first is for safety and the second is for getting interest on their deposits. People can withdraw their money when they require it, so these deposits are called demand deposits. Another facility of demand deposits is check. Through the check, people can make a direct payment without using cash. Loan activities of banks, two different credit situations, terms of credit. You know that a person who deposits money in the bank is called a depositor. And when a bank gives loan to the people, then the bank becomes a lender and the person who takes a loan from the bank is called a borrower. Thus, a person who deposits money in the bank is called the depositor and the person who takes a loan from the bank is called a borrower. We know that people deposit their money in the bank for two reasons: for safety and for the interest they get on their deposits. But the question is, what do the banks do with the deposit which they have accepted from the public? Or how do the banks use the money deposited by people? The banks keep only a small proportion of money deposited by people, and a large part of deposits bank use to give loans. Banks keep only 15% of deposits and 85% of deposits bank use to give loans to the people. Banks provide loans to people for their economic activities like for starting a new business, purchasing a house or cultivating crops. Now the question is, why do banks give loans to the people? Or what is the main source of income for banks? The banks give loans to the people for making a profit. Banks charge a high interest rate on loans, a higher interest rate than the interest rate the banks give to the people on their deposits. For example, if a person deposits 1 lakh rupees in a bank, the bank will give only 2 to 3% per year interest on his deposit. But if he takes a loan of 1 lakh rupees from the bank will charge nearly 10 to 15% interest rate per year on the loan. That means if you are taking a loan of 1 lakh rupees from the bank will charge 10,000 rupees per year interest on your loan. You would have to pay 10,000 per year to the bank as the interest of 1 lakh rupees. But when you deposit 1 lakh rupees in the bank will pay only 3,000 rupees as interest on your amount. This difference between interest rates is the main source of income of bank. Let's observe these two situations and find out how this loan or credit works. The first example is of Salim. Salim is a shoemaker who got an order of manufacturing 3,000 pairs of shoes. To complete the order, he took two loans, first from the leather suppliers and second from a trader. At the end of the month, Salim was able to deliver the order. He made a good profit and he also repaid the money that he had borrowed from the leather supplier and the traders. Thus, in this situation, loan plays a vital and positive role. Another example is of Sapna. Sapna is a small farmer. She took a loan from the money lender for cultivation of groundnuts. But due to crop failure, she was unable to repay the loan. Thus, next year again she took a fresh loan for cultivation and to repay the old loan. But unfortunately, this year too, she did not earn enough to cover the old loan. And she was caught in a debt trap. She had to sell a part of her land for paying off the debt. Thus, this is a painful situation where a loan pushed the borrower into a debt trap. To repay the loan, Sapna had to sell a part of her land. Thus, whether credit or loan would be useful or not depends on the situation of the borrower. There should be some support in case of loss. Our next topic is terms of credit. Terms of credit or terms of loan include the interest rate, collateral, documentation requirement, and the mode of repayment. The interest rate is an amount charged by the lender to the borrower. And collateral. Collateral is an asset. It could be a property such as land, building, vehicles, livestock that a lender accepts as a security for giving a loan. That means at the time of taking a loan, borrower gives the collateral to the bank as a security. If the borrower defaults, fails to pay the loan, then the bank can seize the collateral. The bank can take over the collateral. So the collateral is the asset which has been given to the bank by a borrower as a security for the loan. Documentation requirement. Many documents are required for a loan, such as loan application form, passport size photograph, identity proof, residence proof, and bank account statement. So these documents are required for a loan. And the mode of repayment. There are many ways in which one can repay the loan, like monthly deductions from salary or direct monthly payments in cash. Thus, the interest rate, collateral, the documentation requirement, and the mode of repayment together are called the terms of credit. In short, the banks keep only a small proportion of money deposited by people, and a large part of deposits bank use to extend loans to people. Banks charge high interest rate on loans. The difference between what is charged from the borrowers and what is paid to the depositors is the main source of income of the bank. And whether credit or loan would be useful or not depends on the situation of the borrower. There should be some support in case of loss. The interest rate, collateral, the documentation requirement, and the mode of repayment together are called the terms of credit. Formal sector loans and informal sector loans, and self-help groups for the poor. People take different types of loans from various sources like banks, moneylenders, traders, and relatives. The different types of loans or credits can be divided into two groups: formal sector loans and informal sector loans. The formal sector loans are such loans that are taken either from the banks or from the cooperatives. What are cooperatives? Cooperatives are financial societies. They are run and controlled by their members. Members of cooperative collect their savings to provide loan to its members at low interest rate. And what are the informal sector loans? The informal sector loans are those which are taken from informal sources such as moneylenders, traders, employers, relatives, and friends. Let's see the difference between formal and informal sector loans. The functioning of formal sector loans is supervised by the Reserve Bank of India. The Reserve Bank of India plays a crucial role in supervising the formal sector loans. The RBI monitors whether the banks are maintaining the cash balance of loans or not. The RBI also checks that the banks give loans not just to businessmen and traders but also to small farmers and needy people for their small scale businesses. And from time to time, banks have to submit all the information to the RBI. The banks inform the RBI how much the banks are lending, whom they are lending, and what interest rate banks are lending. But when we see the informal sector loans, in informal sector there is no organization that supervises the credit activities of lenders. Money lenders or traders can lend the money at whatever interest rate they select. Sometimes the earnings of the borrowers are not enough to pay off the high interest rate. And when they fail to repay the loan on time, money lenders use unfair means to get their money back and no one there to stop them. If we observe graph 2 on page number 49, we find that 90% of the loans of the formal sector are taken by rich people and only 10% of loans of the formal sector are taken by poor households. And in informal sector, 85% of loans are taken by poor households and only 15% of the loans of the informal sector are taken by rich households, which means the poor are still dependent on the informal sector for loans and the rich people can receive formal sector loans easily. Thus, it is necessary that banks and cooperatives should increase their lending in every part of India, especially in rural areas of India, so that people can get cheap and affordable credits. And it is also necessary that everyone can get these loans easily. Next, we have the self-help group for the poor. A self-help group is one of the new ways to provide affordable loans to the poor. It is a group of 10 to 20 women who collect their savings and provide loans to the members of the group itself. Members can take small loans from the group at a reasonable interest rate. And after 1 or 2 years, if the group is regular in savings, it becomes eligible for taking loans from the bank. And the loans are granted in the name of the group. The repayment of loan is not only the responsibility of 1 or 2 members of the group, but all the members of the group are responsible for the repayment of loan. Thus, the self-help group are very helpful. They help the women to take small loans without collateral. Women get loans at reasonable interest rates for a variety of purposes like buying seeds, fertilizers or cattle. Thus, the self-help groups help the women to become financially self-dependent. The self-help groups create awareness of social issues and provide a platform to discuss them. During the regular meetings of the group, women discuss different issues such as health, nutrition, domestic violence, and their other problems and try to find the solution. The different types of loans or credits can be divided into 2 groups, formal sector loans and informal sector loans. Formal sector loans are taken either from the bank or from the cooperatives. Informal sector loans are those which are taken from money lenders, traders, employers or relatives. The difference between formal and informal sector loans. The Reserve Bank of India supervises the functioning of formal sector loans. The RBI monitors whether the banks are maintaining the cash balance of loans or not. The RBI also checks that the banks give loans not just to businessmen and traders but also to small farmers and needy people. Banks have to submit all the information on how much they are lending, whom they are lending, and what interest rate they are lending. And in informal sector, there is no organization that supervises the credit activities of lenders. Money lenders or traders can lend the money at whatever interest rate they select. Sometimes lenders use unfair means to get their money back. Thus, it is necessary that banks and cooperatives should increase their lending, especially in rural areas of India, so that people can get cheap and affordable credits. Self-help group for the poor. A self-help group is a group of 10 to 20 women who collect their savings and provide loans to the members at a reasonable interest rate. They get loans from a variety of purposes like buying seeds, fertilizers or cattle. And the regular meetings of the group provide a platform to discuss a variety of social issues such as health, nutrition, domestic violence. Women can discuss these issues and can find the solution. So that's it about today's video. If you like the video, please do like, share with your friends, and don't forget to subscribe. Thank you for watching.